Welcome back. Today, I have a very special video for you. This is something that I find to be the best trading system I've ever created. This is a video on statistical based entries and using the previous market data to your advantage so you can pick and choose your battles and have a massive success rate. A statistical based entry, I'm not sure is a real term. I think it's a term that I kind of invented. And what it is let's look at the definition of technical analysis, using the previous data to make the best future prediction, right? That's what I call a statistical based entry. But what I do is I take it a step further. I use actual hard data and numbers from the past of 12 months of data to make an entry using my option selling strategies to give myself a major advantageous way of collecting premium throughout the year. There's multiple examples of this that I'm going to cover, but I'm going to show you in detail every one of them. One of the great things about statistical based entries and why I like to enter these instead of my normal 0DTE strategies or other strategies is because these come with usually a higher amount of premium for your option selling. They also come with a very high chance of success. And the fact is, they're not very often. They don't come every day. A statistical based entry, for the most part, I get 2 or 3 a month at sometimes, but those 2 or 3 a month can lead into hundreds, if not thousands of dollars of profitability if you know what you're looking for. The first type of entry that I'm going to cover for my statistical based strategy is your everyday strategy. And how I use these is I use my option selling techniques such as credit spreads, sometimes iron condors, to determine when a statistical based entry makes the most sense for that day. So how I do this is I look at the previous data. I'm going to pull up a chart real quick that's going to show you what I mean by this. Let me find this real quick. So the first type of statistical based entry, your everyday entry, what we're going to see here is this is a photo that I use for demonstration purposes. This is an amazing visual for you to understand what I'm really talking about. So if we look at 2020, 2021, 2022, and 2023, the trading days, we only go up to September 1st on 2023. We didn't get the last 3 months, but if we look at the last year of data, right, you can clearly see that we only had one day in 2023, one day from the open of market to the close where it went above a 2% move. So if we have a 1% gap, that is a level where you can enter a 2% spread and give yourself that statistical based entry. If you take a look here and you count these dots, you'll see that there's only 3, 6, 9, 12, 15 to 17 days in all of 2023, which holds true for the last 3 months, where we had a 1.5% move or greater. So using that understanding of previous data, you can make the best outcome possible. And I'm going to show you right now, when I scroll up here, I'm going to find a statistical based entry just like this. We had a large gap up in the market this day. And with this large gap up, I took a statistical based entry that the market was not going to close at 1.7% or higher. And with that, it was less than 3% of all overall days. So I'm taking that statistical based entry. Here's another one with a massive gap up where we were able to take a 2% play. And if you remember the data I just showed you on the last chart, that it only happened once in all of 2023. And that's the type of data that I like entering. Here's a 1.3%. Here's a 2%, a 2%. And here's what I want you to really see is, let's take a look at the statistic. Let's take a look at this word, right? Let's find all. Statistical play, green. Statistical play, green, 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 green. Don't worry, I won't say green the whole time for you, but I will just let you go through all of these logs, all of these trades that I took, all statistical based entries for proof of concept. I don't have to sit here and explain it to you. I just want you to take a look at the actuality behind it. Look, look, look. And if you count this up, you're going to see that I very rarely ever lose a statistical based entry when we have a larger than expected open. This type of day trading is extremely aggressive. It's extremely high risk. You know, past results definitely don't indicate future results. But if you take a look here, one thing you are going to see is that I don't think I've taken any losses. Look at this. Over and over and over and over. Bang. Point proven, right? So you get it now. These statistical based daily entries are very simple to use, very simple to understand, and it's just as easy as looking at a visual like this, counting the dots, putting it in a spreadsheet and understanding, okay, this is the data. And when I have something that approaches the data, I can choose a table that is most accurately going to respond with a win, with a statistical based entry that is going to result in profitability. That is the first type of statistical based entry I use with my option selling strategy, just so everyone knows. You take the previous 12, 24 months of data, you come up with averages for moves. After moves, you can go as far as after a 5.5% gap up, what's the average close? After a 0.5% gap down, what's the average close? What is the data telling you? You pick your prices and your strikes and everything right outside of those averages based on the premium and the credit received, such as that, and you will have yourself an awesome statistical based entry, the first type that I love to use that I just showed you. Highly, highly profitable. You could take a fat loss. Don't get it confused. You can take a fat loss. The risk management on the statistical based entry would be the same as your risk management as a day trade. So whatever your personal risk management is, your size management, your emotional management on a statistical based entry, whatever your day trading rules are, it should match identical. So for me, with a credit spread as such, if I were to get 15 to 20 in premium, I would look to hard stop it at a major support and resistance zone. I would look to hard stop it at $115 to $130 loss per contract. And I would look to stop it if there was a volatile news, high important news, FOMC, et cetera, such like that. So using those details, you can manage your trade appropriately and you can trade these with a massive chance of success. But yes, you could get smoked as well. This one I'm going to show you live. This is a fun one. So let's go to the SPX Weekly, right? This is simple. This is so simple. Everyone can do this. Like when I tell you this is the simplest type of statistical based entry, all right, watch this. We're on the weekly chart on TradingView. 1, 2, 3, 4, 5, 6, 7, 8 weeks. Now, after the 8th green week close, that piqued my interest. I wanted to look back and say, when was the last time we had 8 green weeks in a row? Here's 3, 5. Let's go all the way back. This might take a second. 5, 5. 1, 2, 3, 4, 5. I mean, we had a strong uptrend, but there was red weeks in there. Here we go. 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5. Here we go. 3, 6, 8, 9. 9 green weeks. This is December 2018. We had a big drop off in the market and a strong V-shaped recovery. 2, 4, 6, 8, 9. So we had 9 green weeks in a row. So that's the 18. So what is that? 6 years ago. 6 years ago. So we have an event that recently happened in the market that hasn't happened in 6 years. And prior to that, I believe it only happened once more in the last 20 years. So when we look at that kind of statistical based entry, right, I'm able to now come here, open my options AI brokerage, right? Let me take a log into my options AI brokerage, and I'm able to show you guys an actual trade that I'm currently up $1,000. You know what I took? An at the money call side credit spread weekly, because I said the chances of us having a 9th green week or a 10th or 11th are extremely unstatistical. So a quick and easy way of doing this is looking at your daily and weekly time frames. These daily and weekly time frames are there for you to assess the data and make the best decision possible. So after 8th green week, I took one last week, a little out of the money, and I hit. So I doubled down on a 9th green week and I said, I'm going to go bigger and I'm going to go badder and I'm going to go at the money to say that we have a red week. And right now we are at 74.14. And if you look here, my max profitability is 77.74 or 75. So I'm 60 points out of the money with 1.5 trading days left. I feel very comfortable in this trade. And guess what? If I do take a loss, I go bigger and badder next week. That's it. It's that simple. So this type of statistical based entry that I found on the weekly chart is very simple for you to use. And it also works with down weeks, right? How many down weeks do we really have in a row ever? Look, here's 7 red weeks in a row. And this is back in 2022 when we had a major downtrending year. 7 red weeks in a row. So if I go back, even during COVID, we only had 5 red weeks in a row. So if I go back here, 3 weeks, 3 weeks, I mean, you could just simply scroll back and visualize these charts. But look at this. I'm back in 2015, 4 weeks. So 3. Looking at the data, you can come up with an average amount of red weeks, and you can come up with a statistical based entry. For me personally, it's 4 or 5. If I see 4 or 5 red weeks in a row, I'm most likely going to enter an at the money put side credit spread. And I would feel very comfortable doing so. The market is a uptrending thing. We're talking about the S&P 500. We're not talking about individual shares. We're talking about an ETF that over time goes up. So when you hit something like this, let's just say we waited to the 4th, we would have taken a loss. Well, this is a very short red. We probably would have taken a win, then a loss, then a loss, then a huge win. I'm talking huge. Donnie T style, huge. And then we would have been able to reset and then wait for that level of statistical based entry to allow us another opportunity to scale into a trade as such. The risk management on this is simple. Set it, forget it, and on Friday, you either hit or you don't hit. Partial hit, partial loss, and you move on to the next week. If the candle was green, I'm going harder on the next week because statistically, the odds have become largely in my favor. So the scaling for these statistical based entries, I mean, for the 0 DTE one that I just explained, the first one, you can see that I use my normal amount of contracts. It's a day trade. I treat it like a day trade and I trade it as such. For the weekly, I started off with 1 or 2 contracts. That's it. And you could see here, I have 5 contracts and this is week 2. So scalability is an important thing. The premium is large. I'm happy with $1,200 in a week. That's massive. So scalability. If you go for your statistical based entry on a weekly chart, you should start with 1 to 2 contracts. Everything you do in options should be slowly and incrementally sized, slowly and incrementally taken back, right? You don't have to rush in and say, oh, there's been 8 green weeks in a row. I'm going to full port 100 contracts and I'm going to double my account. You're probably going to lose all your money. You could see here, have a $51,000 account. And I, on Options AI, started with 1 or 2 contracts and I only moved to 5. The max loss for this on $1,200 of premium is like $1,500. It's almost a 1-to-1 R multiple, which is amazing for a credit spread. So if I'm only risking $1,500 in my $51,000 account, that should give you an idea of scalability. That should give you an idea of the risk management you need to succeed, right? You could see my other statistical based entries, right, that I'm going to explain to you here, that I'll explain what those other trades are in my account that are going to make you a profitable option seller. My first entry, looking at the charts here, was after the 8th green week. So my first entry was 3, 6. You could have entered, let's just say you said, you know what? There's been 7 green weeks in a row. And then you took the 8th, lost, 9th, lost, and then the 10th, you won. That's where the scalability is important. I have a certain number. So for me, since the market is a naturally SPX and SPY and SP 500 is a naturally uptrending beast, I only like to enter the statistical weekly call side after 7 to 8 green weeks. And on the downside, since it's a naturally uptrending, I like to enter 4 to 5 red weeks in a row. So if you were, let's just say 3, 6, and you entered on the 7th, you would have lost here, probably won here because it's so flat, and you would have won here. So if you were to start with 1 or 2 contracts, then go to 5 to 7, then go to 10 to 15, you would hit the 10 to 15 and you would be able to make complete profitability over the last 3 weeks. That would guarantee to cover your losses. So making the entry is probably the most important thing, right? Because you don't want to make entry on 4 green weeks. You definitely don't want to make entry on 5 or 6 because you could see that all the time in the market. But after 7, 8 green weeks, the statistics have to tip into your favor. If we use the balance scale and we're slowly doing this, and now it's like, oh shit, I can really enter down here and crush it. And then the balance levels out as we're seeing here. Balances and imbalances, right? It's important to be patient and it's important to scale with the statistical based intention that you're entering. Mine's a weekly intention. I showed you a 0 DTE intention. You need to have scalability and risk management that matches that intention. Of course, it could absolutely smoke us all, go to all-time high up here, and I'm out 2 more weeks in a row. Yeah, it could go 14, 15. Maybe this is the trend that makes a new data set where I get to use for future statistical based entries. You could absolutely get dusted off, but the statistics don't say that. The data tells me otherwise. It tells a beautiful story, and I'm here to fucking read it. Number 3 is a cool one. It's, it's kind of like in roulette. If you're a gambler and you're playing roulette and you see 4 or 5 blacks in a row, most people are going to be inclined, naturally, human psychology, to start betting red. Both of them have like a 46 or to 48% chance of hitting again. So the odds aren't really in your favor. But if we take a look at the daily chart here on SPX, you'll notice 4 red days in a row that led to a pretty substantial drop of almost 2%. So if we look back, wait a minute, Max. When was the last time we had 4 red days in a row that led to a 2% drop? 3 days, 4 days right here. And that's a 3% drop. What happened on the 5th day? It was green. Let's take a next look at another 4-dayer right here. What was the total drop? 2%. What happened on the 5th day? It was green. Let's find the next 4th one. 3, 4. But it didn't fall 2%. It only fell 1.4%, but 5th day was green. Let's find one more. Oh, look at this. Perfect example here of how things can go bad and good. Look at this. 4 red days in a row, which led to a 2% drop. So we're going to say that it's not going to drop any further. This is a red candle, but don't be confused. The price closed higher. There was a large gap up to here, and then the candle closed here. You would have won this trade and had the opportunity to enter another one, and you would have been able to enter another one with 1 to 2 contracts here, take a loss, enter 5 contracts here, take a loss, enter 12 to 20 here, take a massive win. Now that type of scalability scares people, and I totally understand that. And maybe your risk management is not as great as mine, where you're like, I'm not going to enter 20 contracts on a credit spread. That's crazy. But if I had 7 red days in a row, you're damn fucking right I'm going to take that statistical opportunity, because I'm not going to scale back to find the next 7 red days in a row. But I can guarantee you there's 6. It's a hot minute away, and it's during something chaotic. This is 6 days in a row. 7 is just not natural for the market. 5 days in a row. So you can go back as far as you need to go. We're about 2 years back, and here's another 6. A lot of 6s. Not a lot of 7s. So that would have been a very profitable time. So the daily one is a very easy one. I would say if you wait for 4 to 5 red days, you can take a statistical based entry like I have here, right at the money. Look at this. Perfect example. I only did 1 contract. It is no way near my max gain. My max gain is 4,700. The options AI implied move meter says that I'm clearing this by 3-4 points no matter what today, unless there's a news driven event or an unforeseen event that drops me. So this was $180 potential gain. I could close it right now and make $100 on a statistical based entry. Whatever your risk management is, it's important to keep that in place during these trades. This is a level of risk management that I love, is just let it go and I will scale. If I lose this, I'll go to 3 or 4 contracts. It's as simple as that, because you're not going to get these opportunities in the market very often. Most of the time, it's green, 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 red, 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 green, 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 red, 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 green, 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 red, 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 and more green than red, clearly, as the market uptrends, in its entirety, right? A lot more green than red here. But when those reds come, these dips come, right? You could see the large decline in 2022. Let's take a look at this massive one, right? 3 red days, no entry. 4 red days, we have an entry, we hit, we're good. 4 red days, 5, 6, we lose, hit. Okay. 5, we hit. No green entries. So you're able to take this data, look, 5 and a win and another win. If you were to, let's just say, lose that, another one. So you're able to take this data. I think I'm going to go with 5 from now on. Looking at the previous data, I think 5 is much safer and secure route because maybe we do have those 7 red in a row. So 4, 5 red days, statistical entry. 7, 8 green days, statistical entry. And you can get creative. You could take one put side. You could start betting on the weeklies if you like those. Or you can do what I've done here and take an implied volatility move, which is an iron condor. So you're saying I knew that it was going to be a green candle today. I just didn't think it was going to be a green candle all the way back up to 47.50, a massive $4 or $5 day on SPY. So then you can take all of these statistical based entries, be patient, and attack when you need to attack. And I've created this options OI account because, one, it is amazing brokerage for selling options. 2, they have the best visuals I've ever seen when it comes to implied volatility and expected move for these statistical based entries. These statistical based entries implied with this chart is gold, the golden statistical entry setup. Look at this. This tells me that I am clear by 5 points to the upside and 20 points to the downside, and the implied volatility is shrinking. My cone is shrinking. This is a live implied volatility expected move cone. You know, remember, implied volatility doesn't tell you if a stock's going to go up or down. It just tells you that it could go up or down to around these levels, which is also subject to change. So it's not exact by any means. It just looks fucking good. I mean, the way I do the research for the statistical based entries is exactly how I just showed you. I look for previous data. So I love the data tables of the expected and average moves. I love the data tables of the actual moves intraday from open to close and from previous night's close to close. I love all of those datas, like the chart I showed you on the Excel spreadsheet. That gives you the average. That gives you the baselines of where if the average move on the SPY was 0.6%, if you go 0.8% out every time, you're giving yourself that statistical edge. Using TradingView or any trading software like I showed you, that you can just easily look back and pan through all of the candles and write down, it happened on this date at this time. It happened at this date at this time. What was the outcome? What was the outcome? If you get yourself 20 or 30 years of data, which would have taken me minutes to do, I can write it all down and have it in front of me. So when that future pattern appears, I can go, oh shit, this is the data from the last 20 years when this happened. And these are the results. I can play this accordingly. And that's the best way to do it, is to just exactly how I showed you, pan through the data, find the statistics for the last however far back. I like to use 1 year of data minimum for the daily and for the 0 DTE. And for the weekly, I'll go as far back as 20 years. So using that information, you can come up with the best outcome possible for your statistical trading. If you want to learn more about statistical based entries, or you're really looking forward to this trading type and this strategy that I just broke down for you guys, definitely come check us out at maxoptionstrading.com, where you're going to get these statistical based entries and edges all the time, because I am consistently on the lookout for them, and I can show you and tell you how to master the statistical based strategy.